Good morning, good afternoon, good evening, depending on where some of you guys are at on this beautiful planet. I hope you guys had a safe and wonderful weekend. Hey there, Linda, Duncan, Baby Bear, Mirza. Great to see y'all. So today, right in the morning update, we'll update on our $500 challenge. We'll talk about SPX, what's happening, or in this case, what's not happening in the market. And then we'll talk about a potential game plan for the week. So, let's just dive in. We'll start with the $500 challenge to do an update on that. Let me bring it over here so you guys can see. We will go to make sure we are on today's date. Sorry, guys. Give me 1 second. I don't know why this isn't. There we go. Okay. So here is the $500 challenge account. We are still in our longer term SPX trade. So obviously that's down a little bit right now. For those of you who aren't familiar with this longer term trade idea, it is basically based off of some very long term quarterly analysis that I did last year. Um, and it's basically a signal that in the past, every time it's printed, it has followed through with some sort of stronger move to the downside within 2 quarters. And so this signal did print at the end of last year. And we're going on to the second quarter now where there's that potential for a bigger follow through. Now, a few things to keep in mind. Of course, right? The signal may not follow through, even though it's followed through every time that it has printed in the past. We always have to be aware as traders that this could be the first time it doesn't happen, right? So, no matter what, the only thing that we can control in the market is the capital risk that we put out there. That's it. That's the only control that we have as a smaller trader. So, because of that, I made sure to keep the risk within my risk tolerance. I am in this trade for a 130 capital cost. And the idea is if we do end up getting that stronger move lower, which is what we saw in 2008 going into 2009. It's what we saw in the early 2000s during the dot com bubble. It's a signal that printed in the 70s that saw stronger follow through. So if that same narrative does end up happening this time, then we do have a wide broken wing butterfly setup to be able to take advantage of that move. And as you can see with the strike levels that I have here, with our first long strike being at 3,500, the play on this is basically that if we do get a stronger move lower, we'll go down and at the very least test the lows of last year, if not maybe make a stronger move. For those of you who have been following along with this analysis, then y'all know that my more conservative target to the downside, if it does work out the same way, is around 3,200. And that in turn is actually right by quarterly support of the ATR trailing stop at 3,219 and the 30 period simple at 3,181. So it certainly wouldn't be out of the question. If we did get a move down to that level, this broken wing butterfly is a debit style butterfly, so it would still benefit us in a profit. If all we did was test the lows of last year, that would still be profitable. But we also know, of course, that this could be the first time the signal doesn't happen. And so that is why we didn't load the boat in any of my accounts, but certainly not in the $500 challenge, right? We kept our risk at a minimum at $1.30. So that way, one, we still have plenty of capital to be able to trade with, right? In case things do bounce up and we need to cover our risk here. And two, if it does work out, then it's going to make an excellent risk versus reward. This is a 40-30 broken wing butterfly. So if we got the pin for whatever reason going into that expiration, which I probably wouldn't hold for that long, but let's say we did, right? So 40 minus our $1.30 cost basis makes a max profit potential of 38.70. If it went completely in the money and let's say we're down at 3,200 by the end of the quarter, well then the spread width difference is 10 points. So 10 is what it would cash settle for minus $1.30 would still be an 870 profit. Both of those are an excellent return on the $1.30 of capital risk. But like I said, right, we know that there's a possibility this may not work out. For those of you who maybe do have a little bit more risk or just want to be mindful of where to draw the line, maybe you guys did some different style trades, I completely understand. My line in the sand is based off the weekly chart, and that is basically anywhere between the 100 period simple and the ATR trailing stop. I'm going with the higher end here, which is the ATR trailing stop, and that's currently at 42.60. If we really start to break above 42.60 and hold that as a support, then there are trades that I will be skimming out of, right? That I will be scaling back on and trying to protect whatever capital risk remains on those trades. Now, just fair warning, right? For the challenge account, I don't plan to scale out of this one. So it's either going to work or it's not going to work. And I'm okay with that either way. Um, and then Keon's asking for the $500 account challenge, which strike and so I went with the 3,500, 3,460, 3,430 on this SPX trade, and it is set for the June quarterly expiration, June 30th. That way, it gives me the entire quarter for this trade to work out or not work out. And what's happened, unfortunately, in the past, even though this signal has followed through beautifully every time it's printed before, right? It doesn't necessarily give you exactly a certain month within the quarter which in it works. And what I mean by that is sometimes when the signal is printed within the past, the first month of the quarter is kind of choppy, and then you get the stronger selling in the second and third month. Sometimes the first month gets that stronger move lower, followed by the second month, and then the third month of the quarter is kind of choppy. And so, because we don't know exactly what month we may see the selling on, I wanted to make sure to encompass the entire quarter, which is why the $500 challenge is a little bit different than how I normally do it. For those of you who are new and maybe don't know, usually I do $500 each month, and then I see how much I can grow it within a month. If I make profits, I pay myself. If not, I reset the account either way back to $500, and then we start again for the next month, and everything's kept within that monthly expiration. But because of this quarterly setup, I discovered last quarter, whenever I was doing longer term chart analysis, I decided to make it to where this $500 challenge is for the entire quarter. And so it's going to be a little bit different, right? Because we have a smaller risk to work off of, but we also have a much longer time frame to be able to build up the account. And so that's why it's set so far out in time. But we also did take another trade. So let's go over here. And you can see we jumped into an Apple trade last week. So let's pull up Apple here on the charts. Back to that daily time frame. But Apple overall, right, has done a good job of holding up within this range. I was looking for a bit stronger of a follow through back up to 165 earlier in the week. Ideally, we jumped in off this bullish divergent bar with the idea that both of these could end up following through with their higher high and get us back up to 165. That was what I was looking for the entry on this trade. Not necessarily a strong, move to the upside, but just a move back up basically into this price resistance. Unfortunately, the next day, we did get a follow through on a higher high for this bullish divergent bar, but this one didn't work out, right? Within the 3-bar rule I usually give it. So we sat on the trade a little bit because it was low risk. We jumped into the 165 call up. So definitely in line with the risk tolerance for the challenge account. And then on Thursday, we did get that nice move higher back up to test price resistance levels. The high of the day was 165.80. And so certainly when we started to get that nice run to the upside, you can see here, I closed this out a little bit before the end of the close. I didn't want to see a reversal on this, right? The issue would have been if you had held it into the next day, depending on when you got out of it, right? It did go up to a high on Friday of 166.32, but it also had a low of 163.82. And because it was the same week expiration, we had to be mindful of how theta decay works on this. As soon as this 165 strike gets out of the money on same day expiration, all the premium within that strike evaporates, right? Because it has less of a chance to go in the money. So whenever we got that bounce, that nice bounce up on Thursday, it could have been a case where we stair stepped higher. And I certainly mentioned in the alert that if you had multiple contracts, you might hold one into the next day to see if it could get that better follow through. But because I only held the one contract, I didn't want to see that profit go away. So I closed it out for 105, basically a 53-cent profit, just a little over 100% return on risk, which is nice. Obviously, I would have liked for that bounce up to happen earlier in the week because that would have allowed for much better profit. But I'll take the quick 100% return. And for those of you who are solely just following along with the challenge account, what this helps to do, right, is we've locked in a little bit of profit. It helps offset some of the risk on SPX. And it also gives us more capital to trade with. So instead of us having 370 of capital, we now have a little over 420 of capital to now work with for the rest of the quarter to go back into new trade ideas, which I will certainly be looking at for this week. So keep your eyes peeled. If I do see a trade that I like for the challenge account, I will certainly alert it out and let y'all know. And yeah, Trader G, very nice trade. So I know you had a few contracts, so I'm glad some of you guys, of course, always stay within your risk tolerance, but I'm glad some of you guys were able to work out a better capital return in that case. And hey, Tom, good to see you if I didn't say hi already. And so that was one of the trades we took last week. We'll look for some new trade ideas this week, certainly. But let's now go ahead and talk about the market and what we might anticipate this week overall. So jump back here to SPX. Right now, SPX is like nothing, right? You could have slept in today and probably have been just fine if you were looking purely at SPX in regards to the indexes because it has not gone anywhere. We so far for the day have a 12-point range. When we look at the intraday charts, I mean, it is basically in consolidation. We opened basically flat, tried to bounce up and get going, but we have a price level here right around 41.40, which has acted as price support or resistance in the past, depending on which side we've been trading on. In this case, it's acting as price resistance. And you can see that it's holding. Not too far above that is the ATR trailing stop at 41.48. That's, of course, right by 41.50 as a psychological level. Unfortunately, above that, 41.60 has also been a price level. So we have a few levels that have kind of just been in this range of chop. And it might be a bit clear to see this on the daily, but you can see how these price levels have acted the last time that we went back up and tested them, which was back here. And then even further back into last year, we kind of saw some stalling there as price support. We kind of chopped overall in this range back here before that drop down happened. And so it's kind of been a range that we've struggled with in the past and is certainly proving to be a place that we consolidate again. Now, when I look at the daily chart, even though we're not seeing much of any sort of movement today, overall the trend is bullish, right? We can't ignore that. The 10 is above the 30, both are above the 100. Momentum is bullish, still rising with room to continue higher. So that adds bullish strength, right? We're not at the top of the axis yet. But what is interesting today, and it will depend more on how we go into the close, but at least as of right now, notice the Bollinger Bands are kind of flattening out. So that's already a clue that even if we do bounce higher, notice that they're flattening out right by 4,200. And that is right by that 100 period simple on the weekly chart, which is acting as resistance. That's basically where we got close to last time, stalled, and then had this reversal back down to 3,800. So could be a case where we start to stall and drop back down again. Could be that we're going to chop a little, build up energy to then try and break 4,200. Until we break the 10 period simple, I have to keep with the more bullish sentiment based off the daily chart But you always, of course, want to be aware of longer time frames and levels that you might be running into because it's easy, especially as an intraday trader, right? It's very easy to get focused on solely just one time frame, but then you forget about the longer time frames and these bigger levels that might cause an issue for whatever that short-term narrative is telling you. So right now that daily narrative is more bullish. Even on the weekly chart, we have some bullish signs here, but we know how this level has acted in the past whenever we've gone up to test it recently within the last year, year and a half. And so we still need to be very mindful of it, and whether or not it's going to continue to hold as resistance or not. Now, I think we talked about this last time. I'm not sure, but overall, as you can see here, we've had a pretty choppy year so far, right? We haven't really broken below 3,800. That's been the bottom of our range. And we haven't broken above 4,200. We've basically been chopping around this year in a 400-point range, going from support into resistance, back to support, back to resistance. And it could be, of course, that once these earnings come out this week, we have some big names like Tesla and Netflix coming out that could start to sway the narrative of the market to trend one way or another. But it could also be a case, not not that I want to see this, but we always have to be mindful that the market could give us, and what it could end up giving us is a year of consolidation. We saw this back in 2015, 2016 for you guys that remember, right? We didn't really get much of a range. We had pullbacks, but it wasn't necessarily a strong pullback where you would call it a bearish market or any means like that. And what happened is it allowed momentum, which was close to the top of the axis at the time, to get a nice reset and consolidate, and drop back down again. But the underlying price, it took a breather, right? It was like it was in a marathon run and then it finally got a break before its next leg in the marathon higher. And so, as much as I don't want to see a year of chop, it could very well be something similar to that we're getting into now. So once again, just be mindful of your levels, be mindful of the risk. And if it does look like we're starting to reverse, then play back down into support levels. And if support starts to hold, play back up into resistance, right? It's always about playing from one level into the next. And so do want to be mindful about that. That is part of the reason I have been a bit lighter, is because I am certainly more a trending trader. And so chop is not usually something I like to see. But if that is what we're going to have this year, then we need to make sure that we adapt our strategies and our trading, right, to match the market that is presented to us. So do want to be mindful about that. In the short term, though, right, we do have the 10 period simple at 41.14 currently. So that once again could be a line in the sand of support. If we break below that a tiny bit, 4,100, of course, has been that bigger level that we've been attempting to hold to the downside more recently. And if we can start to break above, right, to the upside, then be mindful short term of the ATR trailing stop and of the 4160 level. That's basically right by the highs that we had here before the pullback. But if that can start to break, then the bigger target to the upside would still be 4,200 and higher. Um, and like I said, it could be a day of chop. We have this week coming up things like Netflix earnings, which could be fun to play. That is on the 18th after market close. We also have Tesla, which I believe is the 19th after market close. Yes. So we have a few of the bigger earnings starting to come out. We've already started to see some banks come out. So far, those haven't seemed too bad, even though we had the whole situation with Silicon Valley Bank earlier this year. And so we'll see how that continues to affect the market, if it affects the market at all. But in the meantime, my game plan for this week, I do have a few symbols on my short-term watch list that I'd like to watch. FSLR, I feel like this one I've been really, oh, and now it's starting to go, but it does look like, right, it's finally attempting to break price resistance. So if it can hold above 220 into the close today, With these Bollinger Bands flaring open, we might finally start to get a run into earnings. So that might be one to consider playing. It's attempting a bullish signal. We have a great squeeze. Would like to see some bullish momentum start to appear. This has still been more in consolidation. And this has been a very choppy range overall, but that certainly doesn't look bad to try and play to the upside. Amazon, last I checked, didn't look too bad. Um, to where it might get a run into earnings now. It's a similar situation to FSLR. It's getting a little bit of price resistance here. But if we can start to see that momentum build up, right, we have a great squeeze. Amazon is no stranger to getting a run into earnings. We might be able to do that. And that might be a good one for the challenge account because, of course, after all the stock split with Amazon, it's rather inexpensive on the option side to play, but can still get some really nice moves if we can manage, of course, to break out of this chop. At the same time, I do also want to try and keep the account a little bit even due to the choppiness and uncertainty here. So I will be looking for some potential bearish plays like SRC might be a contender to play to the downside, maybe even a run down into earnings rather than a run. We do have a light issue with this one on the weekly chart where we're right by a weekly support level. But you can see here, there's a lot of bearish sentiment starting to come into play, like the 10s about to cross below the 30. Bollinger Bands are starting to open lower. Momentum is bearish below the zero line with room to the downside. And similar situation, of course, on the daily chart. Bearish moving averages, bearish momentum. This is overall still a bearish signal. Even if that one green box prints today, it's still a bearish signal to play lower at this point. We actually have a bearish divergent bar from Friday, which has not followed through yet. So that could give you a target to maybe play to the downside. And Bollinger Bands look like they're wanting to open lower. It's still a little early, right? It's not a strong flare open like we've seen in the past. But that could, of course, give way if we start to break weekly support and maybe give us some room to the downside as well. So certainly keeping an eye for those things. Yeah, Baby Bear. Yeah, I know JC was also looking at FSLR. I should have just given myself a little bit more time on that. We were in a trade in the Profit Recycling Mastery last week, which was last week's expiration. So yeah, I should have just gone out one more week, but we can always, with that squeeze, right? With the way that squeeze is built in, the probability of this getting a bigger than anticipated run is strong, right? Now, this had the catalyst of earnings, but you can see how that squeezed helped fire it to the upside, even back here, had a decent run higher. Off this squeeze, similar situation, earnings helped out some, but you can see that had a nice run to the upside. So I could certainly see this having a similar situation where even if we're not jumping in until the top range, as long as we can prove that it's breaking price resistance, right? Then that gives us a better probability of moving higher. The issue that we kind of had last week is one, we couldn't even go up to test price resistance, but that was, we were kind of just stuck in this chop. So if we're finally starting to leave the chop, if we're getting that more bullish sentiment down here on the lower indicators, if Bollinger Bands are matching up, then all of that looks good for us to still play. If the squeeze was already starting to fire, then that might be a different story. But the fact that the squeeze is still very much valid and there is a tendency for a lot of symbols, not all of them, but for a lot of them to see some sort of run into earnings, then I certainly think that that makes it viable to where maybe we can jump back in and attempt it one more time, right? And then, yeah, Baby Bear, let's take a look at DVN. So on DVN, it doesn't mean it can't be a short. Uh, it's still below the 100 period simple, which adds some of that bearish weight, but you do have to be mindful that momentum has turned bullish with room to move higher. This is still technically a valid bullish signal, which when you have resistance above us means that we could go up and test resistance. It is technically making a bearish divergent bar today. But I personally may not put as much weight on that due to how this is starting to change into a more consolidating trend rather than the bearish trend it was in prior. Let's go to the weekly chart though and take a look at that. So, and here's the other caution, right, baby bear? So, this is one of the things that I like to do when I'm looking at squeezes or I'm looking at a setup on the daily chart. It's always good to sometimes check the weekly time frame, not only just for levels, but also for momentum, right? Where is momentum? Is it at exhaustion levels or is it set to where it could continue lower? And in this case, we've reached bearish exhaustion, right? We're at the bottom of the axis. We're starting to get green bars pulling back off this level. We start to get a green bullish pullback signal here telling us we could test resistance. And the price itself has started to break above the 100 period simple. Now, that doesn't mean we can't go back down and test it or that we're necessarily going to get a strong bullish move to the upside. It could be that it just starts to chop here. But the exhaustion would probably at this point keep me out of trying to do a strong bearish trade to the downside. Certainly, if there's an intraday setup or something like that, by all means, go for it. But if you're looking for a swing trade or you're thinking this is going to try and reverse before earnings, this here is what would make me pretty cautious about doing anything more directional, right? Maybe a call credit spread or a call unbalanced butterfly in line with support levels if there's enough premium. But that would have me hesitant. If anything, that looks like we could continue the run up into the 100 period simple and then watch if that acts as resistance. If it does, very much like it did back here, then great spot for a call credit spread to try and jump into, or a more directional play if you give yourself some time to play lower. But currently, we have a little bit more room that we could go to the upside, and momentum matches that on both the daily and weekly time frame. But great question. And then Microsoft, yeah, we can take a look at Microsoft too really quickly. So Microsoft here, starting to see some exhaustion. Still very much a bullish trend though. We do have a low compression squeeze. The compound breakout tool is still more in line with consolidation. We went up basically, or we're struggling right around this price resistance around 290. So we kind of opened at that level, attempted to move higher, stalled, and we're pulling back. Now, still very early in the day, and the low of today is still basically right at the 10 period simple as support. But of course, with exhaustion pulling back with some of these consolidating signals, it already had a decent run up. So, what could start to happen here now, because earnings is getting a bit closer, is we start to consolidate into earnings. Certainly could see a intraday setup off of Microsoft, but 290-ish to 292 maybe. I'd be mindful of that level. If it continues to get up into that range and stall, that might actually be a place to short term, scout for a bearish trade on a pullback. If we can start to break above it, then we have a chance to maybe continue this run up into earnings, which is very much still in line with the overall trend. But that is kind of what I'm seeing right now in Microsoft from a daily perspective. Let's check out the weekly real quick. So the weekly still has some room on momentum, still a bullish signal. Squeeze has started to fire. We're holding the 100 period simple, which is good as support. Still very early in the week, but we had a bullish divergent bar last week that already followed through with the higher high, and now it's pulling back. And so if it does end up printing a bearish divergent bar, back-to-back divergent bars kind of fits with that narrative of consolidation to where we might still consolidate into earnings. So be a little cautious of that, I would say, especially if that ends up printing. And it looks like, at least from the last couple weeks, 280 would be a good price support level to maybe play down into. Of course, baby bear, not a problem. And then mRNA has a bearish divergent bar on Friday, and boy, did it follow through. Let's take a look. I haven't played the COVID stocks in a while. I don't typically touch those, but oh, very true. Great bearish divergent bar. Excellent follow through on that lower low. That's what you love to see when that divergent bar prints that kind of follow through. It is going right into support. So be mindful of that. You might, if you took a bearish trade here, don't hesitate to take the quick win. Overall, still have more consolidating to pull back signals, which is what we're getting today. So if it can't break below 140, could actually be a place to put on a put credit spread and play for chop to a bounce back up again. Um, Arguably a little bit lower than that, I would say 135-ish has been kind of the price support level, but with the ATR, you might get the possibility of doing that sooner. Certainly, if it breaks the ATR, then we could start to experience especially if it breaks 135, could start to experience a rollover situation here and the squeeze starting to fire to the downside. Let's look at the weekly. So the weekly has the ATR trailing stop at 124, not that far away. But the trend is attempting to turn bearish. Momentum's very flat. That's more in line with consolidation. It's technically below the zero line, but I would still call that chop over anything else. Um, which is really since arguably last year what this symbol has been doing, right? The low end of this range has been about what 115-ish. The top end of this range has been the 100 period simple, which is currently at 205. And so we've just kind of been consolidating in that range since then. So certainly great follow through on the daily chart, but but I would still be mindful of those levels overall, both up and down. And yeah, last one I can check here, AZN. Happy to pull that up really quickly. So AZN momentum's getting to the top of the axis. Notice how the bars are starting to flatten out here some. So this is the last place where we kind of stalled and saw that exhaustion. Um, so I'd be mindful of that certainly. Earnings is looking like it's anticipated to be the 27th. So could still get a little bit more of a run into the announcement, but like we just talked about on what was it, Microsoft, it could also be a case where we had the run up into earnings a little early and then we consolidate into the announcement, never really giving up the trend necessarily, but not getting that continuation on a strong bullish move to the upside. We didn't make a recent gap here with the high of 72.50. The low today is 73.04. So you might see a little bit more of a pullback here. It would make sense to see that and go down and test the 10 period simple, which is at 72.43. It would also fill that gap. And then, of course, if that holds, that might be a place for a quick bounce. But I'd still be very cautious of right around 75. 75, of course, is a mini psychological level. But like I said, it could also be a place where we start to see that hold and go into chop overall due to the exhaustion on momentum and how the Bollinger Bands appear to be starting to flatten out here at this point for today. Of course, Amit, not a problem. So that is my time, guys. Just I know we looked at a few symbols here, so just a quick review. Overall, nice profit on Apple last week for the challenge account. We're still in SPX, so that's not going to change. I will be looking at new trades this week to potentially put on. Otherwise, though, in short, it may be a choppy, smaller range today as we wait for those bigger earnings announcements a bit later in the week. And if we get some bigger moves off those earnings announcements, maybe we can get this market going. Otherwise, though, my plan is to either start looking more at non-directional trades that kind of benefit from chop, things like credit spreads, unbalanced butterflies, or to look at more individual symbols like FSLR where they seem to be setting up and then trying to play a bit more of a directional move there. But thank you guys so much for joining me. As always, please continue to be mindful of your risk. May the trade be with you, my fellow Jedis. And I look forward to talking to y'all next time. Bye, guys.